Hi, good morning / afternoon, depending on where you are. We are going to be presenting today on preparing sellers to analyze a buyer's fair market value opinion. My name is Curtis Bernstein. I'm a principal with Pinnacle Healthcare Consulting, and joining me is Blayne Rush, president of Ambulatory Alliances. And with that, we can jump right in. Blayne, do you want to give a quick overview of your experience and history here before we start into the presentation?
Yeah, quickly. So I'm an investment banker. We do some valuations, but the majority of our work is sell-side engagements as an advocate, where we're engaged to maximize the seller's position. So the majority of what I'm going to discuss today kind of comes from that, just call it biased opinion. But I obviously understand the fair market value standards and all of that around fair market value as far as the standards, definitions, and what's needed, etc.
Thank you, Blayne. And this is Curtis Bernstein. As I mentioned earlier, I'm a principal with Pinnacle Healthcare Consulting. My background started in health systems, and then on the provider side, internally in companies like hospital systems and providers of ancillary services. Then moved out to the consulting side in the early 2000s and have been doing that work ever since. Got focused primarily on valuation services around 2002 and have been pretty actively involved in valuation services, as well as providing some operational and strategy consulting for providers. So with that, we'll go over our format today is really kind of a question and answer type method, where we will be going over different questions on the fair market value report that would generally be provided for buyers, or sometimes on occasion sellers, as part of a transaction in which one entity is buying or purchasing another entity. So with that, let's start off with general question here of what is fair market value. So fair market value is really a regulatory requirement under the Stark Law, the Anti-Kickback Statute, and the IRS tax code. So depending on the transaction, fair market value may or may not be required. And Blayne, on the next question, is going to go into a little bit more detail on when the standard is required. But we're talking about healthcare here. So in the healthcare setting, if there's any type of referring of patients between the parties that are buying and selling, then fair market value standard generally applies, and it applies under the Stark and Anti-Kickback Statute. So if there's a doctor that owns a surgery center and they're selling the surgery center to a hospital, or a doctor owns an urgent care center or a practice and they're selling that to the hospital, the fair market value standard will apply. In the surgery center setting, it usually applies mostly because of the Anti-Kickback Statute. There is a exception to the Stark Law related to ambulatory surgery, which generally doesn't make the fair market value standard under the Stark Law apply, but it still applies because you have the Anti-Kickback Statute. And I'm not a lawyer, but just dealing with this a lot, I mean, this is really based on my experience. So obviously there's also the indirect referral issue, where those doctors might refer inpatients to the hospital, in which case then you have that other referral issue, and Stark Law may indirectly apply. Obviously you would have to talk to a lawyer. The IRS tax code applies for not-for-profit entities. A lot of hospitals are set up as not-for-profit entities, and as such they are required, when buying an entity from a private individual, to make sure that what they purchase that entity at is at market value, and a lot of people have then applied that as fair market value and following the same methodologies to come up with what is the value of that entity when being sold or purchased by the not-for-profit entity. For how do we define fair market value? We're going to have the actual definition on the next slide, but there's a number of organizations that have been developed to come up with valuation theory and valuation methods to determine what fair market value is of an entity. And those organizations might include like the Appraisal Standards Board. There's the National Association of Certified Valuation Analysts, which has a lot of training and education as well as rules on how to define or establish fair market value. The American Society of Appraisers, the American Institute of CPAs has also established the Accredited Business Valuation Credential and has come up with statements on standards for valuation services, which also helps establish how we determine fair market value. So there's a lot of rules on methods and how to determine fair market value, but obviously there's different nuances to each individual transaction, and we're going to try to go over some of that with the presentation today. Ultimately, fair market value should be consistent with what market transactions are out there for similar companies. The market approach, and we'll talk about that later, is considered the best method for determining fair market value. Of course, you have to dig in and understand the details behind every transaction and make sure you are comparing apples to apples. For example, real estate might be involved in one transaction and not the other. So you don't want to just blindly apply market transactions to your company. And then there's other approaches as well. But ultimately, when you're looking at buying a company and you're looking at what is fair market value, a lot of times we talk about like multiples of EBITDA or multiples of revenue or price per bed or something like that. And that all comes into comparing it to market transactions. And as I mentioned earlier, obviously there's nuances to each of those transactions. So just real quickly, this is the definition of fair market value. Pretty simple parts of this are it's a willing buyer and a willing seller, so it has to be a price that in a market both parties would agree to. They have to have knowledge of the transaction, which means, as I just stated, there's specific nuances to each transaction. So you would need to assume that everybody knows what's going on within the transaction. And there's other issues that come up like highest and best use type terms where there's different buyers in the market, and when we're defining who these willing buyers and sellers are, we need to understand that there's certain people in that market that are willing to pay more than others based on certain facts, and making sure we're accounting for all those facts when we're assessing the fair market value of any business. There's definitions here. We've got the International Glossary of Business Valuation Terms. That's pretty consistent with the definition under the IRS tax code under Revenue Ruling 5960. Just a quick history lesson for everybody. The rules were initially established back in the 30s with regard to prohibition and trying to assess what fair market value was for alcohol distributors that can no longer sell alcohol. And now we've expanded it out to healthcare. And then we added it not just in the tax code, but we've also added it into the Stark Law. And here you have a definition which adds to the IRS definition, says not take into account really the value or the volume of the referrals of the selling party or the buying party as well. So these are just some definitions of fair market value, and I know we want to get more into the meat, so we won't spend a whole lot of time here. Blayne, did you want to add anything more with regard to the definition? And I know you're going to start on to when is it required.
Yes, I want to make a point that's important here, is that it talks about bona fide bargaining between well-informed parties. So the bona fide bargaining is the negotiations of that, and we'll talk about that more as we get into this, but I wanted to point that out, that that's part of the definition and how that affects this entire process. And to go to when is fair market value required, Curtis touched on that, and essentially it's when one party provides items or service to another party that have some sort of referral relationship. And people don't realize all the time and don't think of it, but look at this entire list. So it comes into play recruitment and retention assistance. So just for example, so say a hospital helps a physician practice recruit, retain staff, be it clinical staff, provider, or non-clinical staff. Whatever the whatever transpires there, it can't be free, okay? And the cost to the practice has to come in at fair market value. Office space arrangements, you know, obviously the leases have to be at fair market value. You know, you know, some of the OIG's comments through their guidance talk about their concerns, you know, arrangements under which hospitals provide physicians with items of service for free or less than fair market value. Those are concerns. If they relieve physicians of financial obligations that they would otherwise incur, that's a problem. Inflate compensation paid to physicians for items or services, that poses significant risks. I mean, those are issues. So any of these types of situations require that the transaction happen at fair market value. And I want to make this point here that I thought of earlier to make it clear that not people don't always understand this. Fair market value is a valuation standard. Sometimes people think fair market value is this analysis, this opinion, you know, report, etc. It's not, and we'll talk about more about that in a minute. What they're talking about is that these transactions that have some sort of possible historical or potential future referral relationship must be consistent with fair market value standard. That's a valuation standard. You want to go to the next one, Curtis, or say anything about that?
No, yeah, Blayne, we'll keep going here. So our third party valuation reports required in order to comply with fair market value. As Blayne just said, fair market value is a standard. So the simple answer to this is no. If Dr. Smith is selling his practice or his urgent care center to Hospital A, Hospital A has absolutely no requirement to actually get a fair market value opinion or report. They can easily go out and assess what fair market value is on their own if they have the expertise in-house to do that, and they're comfortable in doing that process. You know, they can negotiate the transaction and come up with a value and come up with a price. So the question comes up, well, why do then organizations get a fair market value opinion from a third-party appraiser? And I think there's language in the Stark Law Q&A and other areas. As you see, we have some language here on the slide, which pretty much says that you know, the folks that are in the Hospital A that are buying Dr. Smith's practice, well, they obviously have a interest in buying that practice, and they want to make sure the deal gets done. They're not independent to the deal, so it's pretty complicated for them to remain independent and I guess assess what fair market value would be of that entity. There's also other areas, you know, they want the referrals of the physician. So from a Hospital A perspective, it's somewhat of an insurance to the hospital to make sure that they are paying fair market value. Another reason is it could be used as a negotiation tool. You know, they have the Hospital A, you know, wants to pay a certain amount for Dr. Smith's practice. They can work with the valuation expert on you know, developing an opinion that helps assess, you know, how reasonable their amount that the value that they're determining is in getting that deal done. We've been engaged by buyers, we've been engaged by sellers, we've been engaged by buyers and sellers together. When you engage a valuation expert, I think it's important to remember that the valuation expert's fiduciary duty is to their client, and that is who they will send their final report to. And the client of that valuation firm has absolutely no requirement to share it with the other party if the valuation firm is not dual engaged. If they're dual engaged, then they would usually have the duty to share it with all parties. So, you'll see valuation reports which just show results and not a whole lot of detail, and it may be the client of the valuation firm has asked not to get all of that detail, or they may not be sharing all of that detail. But ultimately, that's why they get the report, so that one, it's an insurance policy, and two, then they have it as a negotiating tool to show the seller or sometimes the buyer that they've had a third-party valuation done, and here's what that report has come up with.
Yeah, I would add
more on that.
Yeah, I would add that while third-party valuations aren't foolproof, because there's case law out there and cases that they've thrown those out and they've had a lot of issues with them, and the courts have just thrown them out. And they're not a guarantee, but when done correctly, transparently, and for all the right reasons, the government, is, I wouldn't say assured, but for the most part assured that the selection, interpretation of the data, meaning the information that's the basis for the analysis and the report, and therefore the opinion of value, is unbiased by the parties and the stakeholders of the transactions. And like he said, as far as when he used the insurance comment, the transaction becomes easier to defend. So that's why people get those for the most part. And we'll get into a little bit more of what Curtis is referring to as I run into it a good bit, how they use these a little bit different than for that reason. I guess we'll go. You got any more on that, Curtis, or are you going to move to the next one?
No, let's move on to the next one.
All right, so let's talk about what the typical process is versus the correct process. And when I use the word typical, or think of the word typical, it's really based off of, obviously, my experience. And again, the vast majority of what we do as far as the transactions and where fair market value comes into play is representing sellers of ambulatory surgery centers, urgent care, radiation oncology, so essentially physician practices and facility-based service providers. So in many of the transactions, for example, if a hospital health system is the buyer, they'll approach the seller, and if they agreed to move forward with exploring an acquisition, the parties assign an NDA, the system asks for a short list of due diligence material. Essentially that's going to cover the large rocks like the financials, payer mix, case mix, volumes, etc. And that information is typically going to be presented in raw form, meaning how, say it's a physician practice of 3, 4, 5, whatever, they're going to, for the most part, print out or export their QuickBooks and send that information over. And same thing with payer mix, case mix, and volumes. So there's not been any adjustments made, etc. If the system has continued interest, they'll present the seller with a very loose LOI that has some commitments that the seller has to make, but typically virtually no commitments by the buyer. That's especially if that's not being negotiated by, someone like us or lawyers or whatnot. And that they won't have so they'll have some, they'll have an NDA they'll sign. Then once they figure out if they want to move forward, they'll have some loose LOI. And they typically won't have a sale, or sometimes they will not have a sales price, but they'll have something along the lines that the buyer is going to hire a third-party valuer to conduct the valuation to set the price. And then the health system hires a valuation analyst, and without any input from you, so they choose someone that they want. They really don't give you the ability to say yay or nay, don't even tell you typically who that's going to be. The buyer's going to interact with whoever the valuation professional or analyst is, and they're going to give the analyst the instructions, kind of like what Curtis had said early on. And sometimes they're going to tell those guys what part of the business they want valued. I've been in situations where they don't value the entire business because they want to say, oh, we don't value that piece. That's not important to us, so we only want 75% of the business valued. And they'll give them the information that they've received from you to start their work, again in its raw form. And they'll go through the valuation company to go through that information. Typically they'll schedule a 30-minute to 60-minute seller management conference call, but they're not going to give you any preparation instructions. And during that call, they will ask you some general questions. They're not necessarily going to explain the purpose of the question. So a lot of times the sellers are lost because they've not been through this before, and they just kind of generally answer the questions because they don't know exactly what they want, why they want it, etc. Then the valuation professionals are going to go about their work. They'll ask the buyer some transaction structure questions, make some general assumptions on others, but you'll typically never speak with them again. And they'll present the health system buyer with what they call a discussion document. What that is their draft of what the draft of their valuation. And I'm going to say this now and again in a bit in order to stress it, because, and Curtis will go over that in a little bit, talking about how the nuts and bolts of how the actual formulas work and whatnot. But remember that garbage in, you end up with garbage out. And what that means is if the information that goes into this process isn't the right information, the most accurate, isn't adjusted for certain reasons, then there's high probability that the valuation isn't going to be truly reflective of the economic value of the business. And remember that the typical trouble spots is if they pay too much. So there's really not much issue if they pay you too little. So say they want to buy a physician's practice, but they pay you less than fair market value. Well, kickback is the issue, right? So kickback for referrals, kickback for whatever, that's really the issue when we talked about our definitions and some of the laws. There's nothing that says that they can't pay you less than what it's worth. Yeah, there's a problem if a doc pays rent that's under fair market value, but that's not, that's not exactly what I'm referring to here. So it's worth pointing out that in order to correctly value a healthcare business, you got to get into the minute details. You got to know the financials behind the operations. You got to know the expenses for a normalization process in order to identify the discretionary expenses that are available to add back. And discretionary expenses are what we would term seller's discretionary expenses, expenses that don't have an economic impact on the business. For example, just quickly, say that you sponsor your kid's soccer team and it's advertisement, but if they weren't on that team, maybe you wouldn't sponsor them. Say that you have a vehicle on there, but a corporate buyer or a hospital wouldn't have those vehicles. Those are the types of things that are seller's discretionary expenses. So obtaining a general ledger, in my opinion, is a basic element of a data request, but I've never seen it on a data request from a valuation company. If we're involved, we make them take the general ledger, and for people that might not know what general ledger is, it has all the dollars in and all the dollars out of the business. So all checks in, all checks out. And and we go through that line item by line item, and I would tell you that those types of things are what's needed to really get down in the details of the business, but very few ask for it. And to be able to normalize the operating results, like we're talking about, do recast, normalize the financials, you need that. You know, a lot of these guys will say that they make these adjustments or adjust some, but in a sense, what they're really doing is just making general adjustments. You know, I've seen a lot of times they take out all the benefits and add 18% benefits, even if yours was only 5 or 10%, and that's because they've kind of felt that the industry standard is 18%. I'm just using that as an example. Transaction structure is going to affect the value. You know, just knowing the standard of value is not enough. There's so much more. There's substantial difference in the conclusion of value, which is the opinion of value, depending on the transaction structure. For example, is it an asset or an equity transaction? Because the value in the tax treatment changes the value of the business. Is there a seller note? Are the capital leases or operating leases going to be paid off at closing or assumed? What does the non-competes look like? What's the compensation on a go-forward basis? What happens to AR, AP, prepays? You know, there's lots and lots of nuances that are going to affect the conclusion of value, and there's absolutely no way to come to a fair market value per the standards and the law when the valuation analysis is conducted prior to the negotiations. You know, that was one thing that I pointed out in the definition, because transactions just don't happen. Typically, transactions are aggressively negotiated, and many of the deal points have some effect on the economic value. And performing the valuation analysis prior to the negotiations isn't going to get you there. You know, this again goes to the bona fide bargaining. So the correct process is for the parties to negotiate the price, as many of the terms as possible, and then the fair market value analysis is done after those negotiations, those arm's length negotiations, to be able to verify that the transaction price terms comports with the fair market value standards. Both parties should have equal access to the valuation analysts. They should both have access to the discussion documents and the final documents, because the discussion documents, just by the title of it, is there to be discussed, looked at, says, okay, you missed this, missed that, etc. But these hospital health systems, when they hire the valuation firm, they tell the valuation firm to not give that to you, and then they won't give it to you. So those are some of the complexities and some of the issues that kind of prevent the correct process from happening. You know, and there's and I'm not. It's on the client, not on the valuation firm or the valuation analyst, because they're getting their instructions and directions, like was said before, that from their client. You got anything to add, Curtis?
No, I think to reiterate some of the stuff you said from the evaluator perspective, you know, it is pretty common for, you know, especially in certain states where certain things cannot be purchased because of corporate practice of medicine, at least from that's what we hear from lawyers and stuff like that, for us to be told to value certain assets. But from the fair market value standard, and if you look at the definition, I mean, it really is what is the value of the business, and it's a willing buyer, willing seller, not a specific buyer. So the value, fair market value of the business might be X, and as Blayne said, you know, a buyer doesn't have to pay X; they can pay less than X and pay Y. But that doesn't mean the fair market value now is Y. Fair market value is what the buyers in a market are willing to pay, and there may be other buyers willing to pay, you know, putting numbers X and Y, you know, maybe willing to pay $1 million, And just because a buyer wants to pay $800,000 doesn't change the fair market value of the business. And even if it's, as Blayne said correctly, if they just want to buy a portion of the business, we just want to buy, or just want to value a portion of the business, I should say. If you just want to value the infusion services of an oncology practice, but there's also the physician practice, doesn't mean the fair market value of the overall business is just the value of that infusion practice. It would be the value of the whole thing. And we've been told to just value a certain component of it. And that obviously has to be made clear between buyer and sellers and stuff like that. Next part is, how is fair market value calculated? And Blayne has gone into a little bit of this in the last part. And I think, like Blayne said, this really is a lot of the meat on how do those formulas work when a valuation expert is coming up with a fair market value opinion, trying to remove the veil from what's in that big report. And as I mentioned earlier, the market approach is one approach that's used. It's usually considered the best approach to valuation. It's what are other people paying in the market for an entity. The limitations on the market approach are just lack of data. As I mentioned earlier, you really need to understand the transactions to understand how you apply that to a specific transaction that you're working on now. So if Dr. A sold his surgery center and Dr. B wants to sell her surgery center, there's obviously going to be differences in the surgery center to try to come up with where that surgery center falls on the scale of multiples that people are paying for a similar type of interest in that surgery center. So using multiples, we may say 5 to, let's say, 8 times EBITDA, and why is one worth a 5 and one worth an 8? Putting it in a simple approach, we all, or most people I should say, own houses, and when you're looking to buy a house, you can look at the square foot. One house could be 5,000 square feet, another house could be 5,000 square feet, but one could have granite countertops and a pool and all fancy Italian tile and built out back patio or something like that, and be worth more than the other house that's 5,000 square feet. So very similar type model here with businesses. The income approach, when the market approach is not applicable, the income approach is usually the approach that most valuators will use, especially for going concern businesses or businesses that are profitable. The income approach, in simple terms, looks at what is the income or cash flow that the business is going to generate in the future, and then what is the expected rate of return of a buyer of that business. So to simplify that from a banking perspective, we always go over that example of, if I put $1,000 in the bank today and 10% interest, what am I going to have in a year, right? That's $1,100. So backing that up, if I want $1,100 at the end of the year, I'm able to get 10% interest. How much do I have to put in the bank today? So that's the income approach. It's how much do I have to put in the bank today? How much do I have to pay for this business to generate my 10% return and have $1,100 at the end of the year? As was mentioned earlier in the definition of fair market value, you can't take into account the value or volume of referrals. And this was what Blayne had mentioned. There's certain case law out there where valuation firms have done valuations that take into account the value or volume of referrals. There's a case up in Pennsylvania with Allegheny where a hospital, it's called the Bradford case, where a hospital was looking to purchase the business of a cardiologist and enter into a non-compete. It was the nuclear medicine and EKG business. And you see this a lot in the industry where hospitals will be buying ancillary services of physician practices like EKG, nuke med, infusion, ambulatory surgery, those types of things. And they take what the business is currently doing. Well, in this case, the CFO was looking at what business they would otherwise lose if they didn't buy it. So what referrals would be made by the cardiologist to the hospital, and that was the nuance that led to the value or volume referrals. So from a valuation perspective, we try not to, well, we can't account for the value or volume of referrals. We can't add in projections, well, we're going to get all these new referrals, or the reimbursement's going to be a lot higher because now under a hospital context, and those referrals are going to generate this much more revenue. You can't do that from in a healthcare valuation perspective, even though it may make common sense on other industries. And when you're doing a deal, it just may make sense. So even with a valuation, if that valuation takes into account those value or volume of referrals under the income approach, it's a meaningless valuation and should not be relied upon. And I think that's part of our goal here, is to try to make sure people are educated on those things. If the entity is not profitable, or in some cases we have valuators that are even taking an asset approach if a entity is profitable, but they're valuing intangible assets on kind of a cost to recreate basis, where the asset approach may be higher than the income approach. But ultimately, from a valuation perspective, the asset approach has always been the approach of last resort, meaning it's kind of the basement or lowest value. It's just, what are your hard assets equal to? And then, as I mentioned, there may be some minor intangible assets if you're not a going concern or a profitable business. So that's how a valuator usually decides what approaches they are going to take. Even if the market approach does not have, even if there's not enough data available to apply a market approach, valuators that have expertise in this industry and are constantly talking to business development folks in specific areas like urgent cares and ASCs have a sense for where the other approaches should fall out, and we'll use a market approach / market data as a kind of test for reasonableness for the other approaches. So when applying the income approach, as I mentioned earlier, it's what is the cash flow in the future. So you're always going to start with projections. And as Blayne said, this is where you get into those adjustments. You know, what are the adjustments we can make to the historical income statement when projecting out future income? And from a valuation perspective, that always starts with a management interview. I think a lot of valuation firms are out there checking a box. You know, as I mentioned, there's valuation rules on how you go about doing a valuation, and management interview is always important to creating the valuation. And so a valuator will say, okay, well, I'm going to talk to the management folks, but it doesn't matter what they say, I'm just going to grow everything at 3%. So you got to be careful with that as well, and make sure that whatever's input in the management interview works its way into a projection, especially when that projection is performed by the valuation expert. And as I mentioned, you know, as Blayne said, this is where you get into those discretionary earnings. And there's other stuff that just may not happen post-transaction. So if you're an owner of a business, for example, you may get a deduction for auto expense, or you may have significant types of long-term disability or life insurance or other stuff on the books that you might not get now as an employee of a new entity, of the buying entity. So those kind of things all need to be adjusted. If you made a big investment in EMR, you know, those types of things all need to be adjusted. The easiest way to do that is, you know, have someone like Blayne who's coming in and create a seller prepared projection. That way the valuation expert doesn't have to do it. Now, even with seller prepared projections, I still think they have to be reasonable. I mean, I've been involved in transactions where certain investment bankers have been involved, and they've come up with projections that just absolutely make no sense. And, you know, we've gone through the process of saying, well, what would the value of this business actually be had we valued it based on these projections? And the numbers are just astronomical to some extent. Taxes are always a big issue. I mentioned earlier a number of hospitals are not for profit, but from the valuation perspective, we're always looking at a willing buyer and willing seller. So as long as there's entities out there that are taxable, we work taxes into our projections, and those come off because that is off the cash flow that a potential buyer would earn as a result of buying this business. Blayne, did you want to add anything on projections before I get into discount rate?
Well, only that when he talks about making the adjustments and he uses the vehicle and whatnot, the cost of that gets added back. So say that you've paid in, just making this number up, it's irrelevant, but it's $10,000 this year, could be $100,000, whatever it is, that gets added back to the profitability of the business, because you're not going to have that as an expense post-transaction, or you're not going to have it as a benefit if you stay on, et cetera, post-transaction. So what he's talking about there is adding it back to the profitability of the business. So therefore, if it's $100,000, the business is going to be $100,000 more profitable through the adjustments. You find enough of those, and you'll see that it's a significant amount of money. And the valuators, how do I put this? I mean, I'm just is that they're quote unquote not paid enough, and there's not enough benefit to them to go through there and look at the general ledger typically. So the hospital only wants to pay for a summary approach or a calculation approach, not a full-blown valuation that costs significantly more. Well, they're wanting to cut corners, so therefore they're directing their valuator to cut corners. And if you don't have this, and we'll talk a little bit more about some of the things that you can do, if you're not doing that for them up front, you're leaving a significant amount of money on the table. Go ahead.
Okay. So now, once you've done the projection, you've come up with how much cash flow is a buyer going to receive post-transaction. What are they going to be able to achieve? Then the second part of that, from my banking example earlier, is the discount rate, or from my example would be the interest rate, right? So you've come up, I'm going to get $1,100. Well, now how much do I want as a return per year? So that's really the discount rate. And obviously different buyers have different thresholds on how much they need as a rate of return on their investment. So the higher the discount rate, the lower the value. So when we're carrying it back, with my example, I gave you 10%. Well, if you need to get a 20% return, well, then you're going to put in less than $1,000. If you put in 900 something, like 920, whatever the math comes out to be, you get your 20%, and then you have your $1,100, right? So the higher the discount rate, the lower the return. And so what a valuation expert is out there doing is they're trying to define what's the rate of return expected by the market. And with projections, it's really amazing to me how much, a 1% change in that discount rate up or down can really affect the overall value of the business. So looking at the inputs on that discount rate, a big one that is highly up to the valuation expert's judgment is what's called the company-specific risk premium. So a valuation expert will look and say, well, what do other people in a market expect as a rate of return on stocks and debt, right? And that might be for a fully diversified company like General Electric. Well, the surgery center is not General Electric. It's a little bit more high risk. It's not fully diversified. Doesn't have a huge portfolio of companies. Maybe you're pretty reliant on a couple of physicians, and therefore it's a lot more risky. The question is how much more risky, and that's the company-specific risk premium. And that also comes into that other information that Blayne had mentioned earlier, like case mix and payer mix and stuff like that. A lot of it's Medicare, Medicaid, and relying on one payer that could ultimately, if regulation changes, could significantly affect revenue. Well, those are all risks. But how much does that risk affect the discount rate is really at the judgment of the valuation expert. And so looking at that discount rate could significantly affect the value. If you're selling 100% of a company, a valuation expert will then decrease the value for the working capital that the buyer is going to have to put in to maintain the operations of that business. And that usually happens, especially in the healthcare setting, because on these deals you usually don't see accounts receivable or cash transferred. So if there's no receivables to continue to collect, to continue to pay payroll, well, now the buyer has to come up with some cash to continue the operations of the business, and we call that working capital. Now, how much that is necessary may vary as well, depending on the valuation expert and the market data they're looking at. They may look at a percent of revenue. They may look at days operating expenses. They may look out to the market and come up with a number, and that number may be inconsistent with what the center or the entity has done historically. It may be have used 5 days of operating expenses, and someone may adjust that to 30 days of operating expenses. So looking at those assumptions and trying to understand why a valuation expert has come up with those assumptions can significantly affect the value, as well as annual changes in working capital, because as the business continues to grow, the buyer will have to continue to invest in working capital to continue the operations and growth of the business going forward. Blayne, did you want to add anything to these couple of sections before I move on to the market approach?
No, you're good.
Okay. Market data, very similar to stuff that I've already talked about here, making sure the transactions are similar in nature. Correlation must exist to use the data. For example, what is affecting the change in EBITDA? What is affecting change in price to revenue or price to bed? You know, you need to have some kind of correlation between the data to apply the market approach. Otherwise, it's just really professional judgment on the part of the valuation expert. So another way to look at it, you could say, got a range of 5 to 7 or 5 to 8 for a surgery center, and I have my surgery center, so why is my surgery center 5 versus an 8? And you know, there's probably not a whole lot of correlation between the data, so a lot of it is valuation expert judgment. Sample size must be robust enough to be valid. You have to have enough data points. If I have 2 data points, one's a 5, one's an 8, that doesn't automatically make my range 5 to 8. You probably need, you know, 15, 20 different types of transactions to validate that that's a reasonable range. And outliers are generally discarded when applying a market approach. And there's usually a reason for an outlier. You know, for example, significant real estate, if you could always make an adjustment and make it not an outlier and then rely upon it. But there may be other reasons. I'll give you an example in the consulting industry. Huron recently bought a consulting company owned by a very well-known consultant and a leader in the healthcare space and paid a pretty significant multiple. And if you put that multiple in the overall realm of consulting companies, well, it's a significant outlier that should be discarded. I think it was like 45 times EBITDA or something like that. So just different things to consider when applying the market approach. If you're buying and selling minority interests, which are more common, I think, in the ASC space and like an urgent care space, you'll usually see a valuator apply what we call discounts. There's discounts for lack of control, discounts for lack of marketability, key man discount. There's various types of discounts out there. Somehow this got copied over. We'll have to fix the bullet points on this because these are not the bullet points for discounts, but that's okay. We'll fix it anyway. There's various things to consider in discounts. So like discounts for lack of control. The question that always comes up is, would this be otherwise run in a manner if the entity controlling the business did not have control? You know, are there things that could be otherwise done differently? For the discount of lack of marketability, you know, are there buyers of the entity out there in the market? One thing that comes up is cash flow, and is the seller going to continue to get cash flow from the business even while they're trying to market the business to potential buyers? You know, those types of things reduce discounts. Key man discount is a discount related to having like a sole person. Each of these discounts also can be accounted for in the discount rate. So you got to be careful from a valuation perspective, or you may want to look to make sure the valuator isn't counting those discounts twice. Like the key man discount, I may say this business is a lot riskier because Dr. Smith does 90% of cases, and God forbid anything should happen to Dr. Smith. Well, there goes the business tomorrow. So that's significant risk. You're not going to take then a key man discount again based on the fact that Dr. Smith does 90% of the cases. So you see that a lot where somebody will increase the risk on the discount rate and then lower the value on a discount, which, as I mentioned earlier, the higher the discount rate, the lower the value. So we're going the same way twice, and you want to make sure that doesn't happen on the valuation process. Blayne, with that, you want to jump into
Yeah,
language
I'd
of
like
seller
to make a
required?
comment about market data.
Yep.
So one of the big arguments against using the comps or market data comparables, et cetera, is that there's sometimes not enough good data, good comps out there, because a lot of these happen in the private capital markets, which by definition are private, and obviously people that are involved in these transactions have that data. But whenever we go and we're involved, what we're trying to do is go to market and make the market. And so we're trying to go out there and get multiple bona fide offers and negotiate those bona fide offers up, and then end up with a buyer that we end up with some transaction structured document. And some of the standards, and Curtis had spoke about the different certifying bodies or the different association organizations that are that set a lot of the definitions and the different nuances of the standards. Some of them will say that, and I agree, and we support this, is that they're to use all of the available data, which includes those bona fide offers. So if we go out there and collect bona fide offers, and they're true bona fide offers, I'm not talking about some hanky-panky, because that's always asked by the lawyers sometimes, and no, I'm talking about bona fide offers that are true. That becomes your market data, and they should be using that information, and they should be using the information that you've negotiated. And because there's some case law that's come out and said that we support the negotiations and what they came up negotiations above what the hired valuator came up with. So there's support out there for that. But moving on to this, what should be required in the letter of intent. And obviously those things are negotiated, but this is something people don't think about, because they don't, the sellers typically, this is, they're novice sellers, and this is their largest transaction that they'll ever do in their lifetime, and they'll only do one or two of these in their lifetime. And so go to the next slide. Here it is. These are the things that we push to get in there. And if the health system or the buyer, so we keep talking about health systems, but there are other types of buyers that also have some sort of referral relationship, or even some require or want this appraisal or this fair market valuation analysis. So we work to put this in the letter of intent. What this sets is the framework of how we're going to work with the appraiser, essentially, that we're going to have to agree on who the appraiser is. So if the buyer says, hey, we require this valuation, fine, well, you're going to pay for it, but we're going to have to agree on who the valuator is. We're going to have to get the same level of access to that appraiser that you get. We're going to be able to see the discussion document, the rough draft, if you will. We're going to be able to go through it and look at it and point out why they're wrong. We're going to be able to challenge their professional opinion and debate that. I've done it many a times, and they change it. One is capital expenditure going forward. Well, we have a brand new, the facility's only 5 years old, the equipment's 2 years old, etc. We don't need that capital expenditure that you're putting in here. And so they lower it or take it down to zero or whatever. It's probably not going to be zero, but they take it down significantly. And so this needs to be put in there and needs to be discussed, and you need to make a big issue of it, because in my opinion, the buyers should not have a problem with this unless they are trying to use that person, and I guess it kind of goes into the next question, as their consultant versus a third-party independent valuator. You have any comments on that, Curtis?
Nope, and we have about 5 minutes left. So.
All right, so we'll run. So my point here, when is the fair market value analyst no longer independent but a consultant? So if they go in there and they set the price, they have all their conversations with their quote-unquote client, the buyer, and they don't let you be a part of that. They don't share all that information. Then how are they? How are they independent? When a buyer hires the valuation analyst and that analyst sets the buyer's price and not merely verifies it, if verifies the negotiated price and terms, gets his or her direction from the buyer, spends the vast majority of their time interacting with the buyer prevents or says no for the valuator from sharing the full copy of the discussion document, nor allows you to speak directly with the valuation analyst to point out any potential errors. How can that valuation analyst be independent? Curtis might have a different opinion, but I'd say they cannot be an independent third-party evaluator working in that manner, and they're a consultant to the buyer. Remember, there's no laws, and we talked about there's no laws that require an independent third-party valuation, nor is it typically an issue if the buyer pays lower than the fair market value when purchasing the business. Go ahead, Kurt.
Right. So from a independent perspective, the rules are pretty much you can't be an advocate for your client. So I think that's the drawing line, is when you step over that line and become an advocate instead of an independent party and just doing your valuation work. We commonly give advice to our clients, especially when they haven't engaged someone like Blayne on some terms and stuff like that. But you got to be careful when you step over that line from an advocate perspective. So last part here, some common misconceptions with valuation. Blayne, you want to go over the first one, and then I'll jump into some of the other ones?
Yeah, so talking about goodwill here, a lot of things, especially when physician practice acquisition, the staff of the hospital will say, and I'm sure a lot of people heard this, hey, we'll pay for tangible assets, but we don't pay for goodwill. Well, goodwill is the value of the healthcare entity's ongoing business operations in excess of the value of the tangible assets of the business. Well, just think about that. For a successful going concern business, meaning it's going to be continue in business, the analyst would expect that the healthcare entity has some sort of goodwill. Physicians receive value through either upfront purchase price or ongoing compensation. Oftentimes hospitals are putting more value into ongoing compensation, so they'll say, well, we're going to pay a little bit more on compensation. Well, goodwill and other intangible assets are an important part of a physician's practice. And there's no legal constraints for paying goodwill. It is not paying for referrals, and it can be beneficial from the perspective of both the buyer and seller. Paying up front for goodwill rather than increased compensation can possibly affect the ongoing future cash flows, meaning it can be in the buyer's best interest to do so. And here's the reality of it. For a doc at the end of their career, he's going to value, typically he or her is going to value upfront payments for goodwill versus ongoing compensation. Because say that they're going to work 2 or 3 more years, and say that it's 5 to 7 multiple. Well, think about that. If you get 5 or 7 times your money versus 2 times your money, meaning 2 years, what are you going to value more? But a doc earlier in his career, they might value an increased compensation package. Many hospitals believe that it's prohibitive, and it's not. Go ahead, Curtis.
Yep. A couple other things here, just to address with regard to valuation, is that we commonly see folks just putting in fair market value compensation at median based on a specific partner not partner type model. Fair market value compensation is regardless of place of employment, whether it's hospital employment or physician practice employment. It's for a physician of a certain level of experience and background. Just because something is fair market value does not mean it's commercially reasonable. That's come up a bunch of times recently on whether some transactions could be done. There's been some language in some case law by some experts that I definitely don't agree with as far as what makes some things commercially reasonable. And we look at an entire checklist of business terms to determine whether something is commercially reasonable. I know we're out of time here, so I don't want to take any more time out of people's day. I appreciate everyone for taking the time to listen to our webinar. Our contact information is on the screen. If you need to reach Blayne at any time or myself, please feel free to reach out. We're always happy to answer questions and help you on your latest transaction or business deal. Blayne, anything you want to close with?
No, I just appreciate everybody's time, and feel free to call, because one thing that I wanted to cover that we just ran out of time is some of the things that the sellers can do in preparation of the process. And if that's the interest of someone, just call or send an email, and we'll send that out.
Yep. Sounds like a great topic for another webinar, Blayne, and please continue to look out for other webinars from the Ambulatory M&A Advisor. Thank you, everyone. Have a good afternoon.